Hey, it's John from stopsaving.com, and welcome to the next video in our course, Technical Analysis Simplified. In this one, we're going to talk about price support and resistance. Just like with trend lines in the last video, these are simple yet powerful tools for any trader. And here, we're going to learn how to find price support and resistance and how to trade it. So on that note, let's jump in. And here's what you'll learn in this video. Number 1, how to find and draw price support and resistance. 2, why it's good to buy at price support. And 3, why it's good to sell at price resistance. Then number 4, how to spot support resistance flips or SR flips. And finally, number 5, how to connect price support and resistance with trend lines for extra confirmation. So let's start with price support, and you can think of this as an imaginary trampoline below the price. And each time the price hits that trampoline, it bounces up. But sometimes that trampoline breaks because sell pressure gets too heavy. And that's what we see here with Bitcoin on the one-day chart back in 2018. You can draw a support box by connecting 2 or more lows. And in this case, there are many lows, which draws the support out for much longer. And because lines are never going to be exact, it's better to draw a rectangular box than a line. This can give you a potential area of buyer interest rather than an exact price point. Now, as with drawing trend lines, use the line of best fit approach. Connect candle closes or wicks to get a horizontal area of support. And sticking with our trampoline analogy, the more time support is tested, the more likely it is to break. And in this case, Bitcoin's support broke down in a big way in late 2018. On a daily close below that support, or a pullback up towards it, it would have been a good time to short Bitcoin. That's because the support lasted for so long that when it finally broke, there were just no more buyers left to prop up the price. So let's now look at price resistance, and you can think of this like a ceiling on the price. Each time the price gets to the ceiling, it gets pushed back down. But after enough tries from the buyers, the price can break that ceiling and go to the next level of the building. And that's what we see here with the US dollar index on the 1-month chart, with this yellow resistance box going back almost a decade. To draw a resistance box, you can just connect 2 or more highs. As with support, a box is better because resistance lines are never going to be exact. And you can use the line of best fit too. Notice how this one has wicks and candle closures around the resistance box. And using the ceiling analogy, the more times that ceiling is tested, the more likely it is to break. And just look at what happened here when that ceiling eventually broke with the dollar index. You could have bought the index on a monthly close above resistance or after a retest of the resistance from above for risk management. Let's now look at what happens when support becomes resistance and vice versa. In trader lingo, this is called a support resistance flip or SR flip. And here's an example of a bullish SR flip for silver on the 1-week chart. In this case, the previous resistance gets broken in early 2020. The price goes much higher and then comes back down to support later on, and then bounces back up off it. In other words, the previous resistance has now become support. As a trader, this is the kind of thing that you should get really excited about, because you know where the last resistance was, and you know there's a good chance that it could turn that into support. So it's a good time to start buying. And if the support breaks, you can always get out for a small loss, i.e. buying on a bullish SR flip can offer you good risk to reward. Of course, you can also have bearish SR flips too, where previous support becomes resistance. And that's what we see here with silver if we zoom out further in time. In this case, the play is to sell or potentially go short at resistance. Now the next thing we'll cover is what we call a bullish deviation, and that's what we have right here with Bitcoin on the 1-week chart. The deviation works like this. First, price closes below the support, like it did here. Now, if we consider the trampoline breaking analogy from earlier, that's usually a bearish sign. But not this time. After a few weeks, the price closed back above the support after a quick deviation below it. This can be incredibly bullish if you think about what's going on in terms of buyer and seller pressure. See, when the support broke, sellers had their chance to push the price down further, as everyone was bearish at the time. But despite that, they still couldn't get the price to go lower. Instead, buyers came back and pushed the price back above support. And by that time, the sellers had already exhausted all their sell pressure. Also keep in mind that many traders would have shorted Bitcoin when it got below support. Now, the only way to exit a short position is to buy back Bitcoin. So when price started going higher instead, they were forced to buy Bitcoin all at once. And that made the price go up quickly. That's what we call a short squeeze. You can also think of this particular bullish deviation as a bear trap because it trapped all the Bitcoin bears. You might recall that the close below support was after FTX, a massive crypto exchange, collapsed. So even with all that bad news, the sellers still couldn't push the price lower, and that was actually a bullish sign at the time. As a general side point, markets tend to bottom on bad news, not good news. And this makes sense logically when you think about it. If the news is really bad, that means every bear who would have sold is probably going to sell. So if that happens and the price still can't go lower, it's usually the final blow for the bears. And this is exactly what we saw here with Bitcoin, which went on a massive rally afterwards. Also notice how the price retested support later on. Buying there would have been a good lower risk opportunity as a trader. Just keep in mind that price doesn't always have to come back down to retest support. Of course, you can get bearish deviations too, like this one for the altcoin GMX on the 1-day chart. And this is basically the opposite. First, the price closes above resistance. This is usually bullish and got a lot of breakout traders buying the GMX token, most likely on high leverage. But then, instead of flipping resistance into new support, the price closed back below the resistance after a quick deviation above it. Now, all those buyers would have set their stop losses just below support, so when it broke, they had to sell GMX at a loss to get out of their trades. In other words, this was a bull trap because it trapped the bulls. This is why it's usually a lot safer to buy on a retest of the resistance than on the breakout, because if the resistance doesn't turn into support, you won't make such a big loss. That's because if you buy on a retest of resistance, you can set your stop loss just below it. That means you can set your stop loss much closer to your entry price, which makes your loss much smaller if the trade goes against you. As you'll learn throughout this course, technical analysis works best when there's more signals saying the same thing. And on this Bitcoin 1-week log chart, we can see trend lines and support work well together to give a good buy signal. After the bullish deviation, when the green candle closed back above the blue support box, Bitcoin also broke this downward trend line in grey. That was buy signal number 1. It then came back to retest the blue support box, which just so happened to be in line with the bigger downward trend line in white. This had been in place since the start of the bear market, and that was buy signal number 2. And here's an example of this on the bearish side. Here, Bitcoin got rejected at both the horizontal support box and the diagonal trendline retest in white. This was a pretty good time to go short, if you ask me. So that's the end of this video, and here are the key takeaways. Number 1, support is when 2 or more lows hold. 2, resistance is when 2 or more highs hold. 3, it's better to draw support and resistance boxes than lines. That's because the numbers will never be exact, and there's usually lots of volatility around these areas. Number 4, the more times a support or resistance box is tested, the more likely it is to break. Just remember the trampoline for support and the ceiling for resistance. And finally, number 5, buying at support and selling at resistance is a simple way to reduce your risk in trading. So that's it for support and resistance. We've now covered some of the more basic but important concepts of trading and technical analysis. In the next video, we're going to kick things up a notch by looking at price compression patterns. So thanks for watching, and I'll see you in the next video.